Welcome to a special edition of the China Show. We're coming to you live from Bloomberg's inaugural China Credit Forum here in Hong Kong. I'm David Ingles with Yvonne.
What exciting times. The leading analysts and key market players are joining us here over the next 2 hours to dig into the emerging risks and opportunities in China's $13 trillion debt sector as we count down to the market opens. This morning, you're watching the China Show. We're taking the show on the road.
Yeah,
One
somewhat.
Floor up. Studios here right now, here at Bloomberg's Asia headquarters for, of course, we talked about the inaugural China Credit Forum. And what a time to be having this, Dave, right? As we talk about how this property downturn is entering to this new phase where we're talking about, it's more about debt restructurings, wind-up orders, and really where we are in this credit cycle now.
You know, it's interesting because timely enough, and here's the first plug. There's a great story out from our colleagues that they put out. You can check that out on the Bloomberg terminal. It's on the website as well. It really lays out just the total amount of restructuring that's coming out, right? Yeah. So it's at least 23 companies have been
receiving wind-up orders.
At least 5 of them have been ordered to wind up.
Including Evergrande.
Right?
Yeah.
So Evergrande's the biggest one. You have Country Garden. And I was tallying up the names. I think we're looking at 9, 10 names there. You tally the liabilities up of each one, you're almost at $1 trillion, right? So it's a massive order. It's complicated. There are multiple parties involved. Plus, of course, it's happening offshore. On the question on timing, too, that's interesting because apart from what's happening in the equity market, so property stocks have been flat. We know, of course, the rally that's taking place in equity markets in China. The high yield space has been doing very well.
Coming back.
Yeah. How many weeks?
It's been quite resilient, right? I think it's basically been up every week since mid-December, right?
Yep.
We're talking about the high yield space. It's the offshore market that seems to be outperforming as well. So you got to wonder, have we seen the worst in this property downturn here right now? We have a stunning lineup of guests coming through the next 2 hours to kind of walk through all the themes. And, of course, first on deck is our keynote guest for the first hour. Yeah,
so in a couple of, let's say, 2 minutes or so, Chua is going to be joining us from Bain Capital. There he is, of course. We'll be getting to this initial conversation in just a moment, but to give you a tease of what's coming up here. So all of the big themes, right? So we're doing everything from property risks, where are we in the story? We're talking about this very nuanced part of the China conversation, which is really LGFVs. And, of course, Yvonne will be moderating that panel. What's coming up there?
Yeah, I mean, obviously there's been a lot of deleveraging that's going on. How are policymakers balancing that with, of course, boosting growth as well? There's also been a lot of resilience in the LGFV space as well, despite the fundamentals not really improving that much. So really, what are the opportunities now? And have we kind of reached the less of a concern of maybe a public default in the LGFV?
Yeah, well, we talked about that, I think, back in October.
Yeah.
Right? There was a massive backstop, that swap program as well. Private credit's very much in focus, very much part of the conversation. We'll be having that also this hour as well. And to wrap things up, really what the future looks like as far as China credit is concerned, right? So everything from the offshore bond market to loans. So stay tuned for all of that for our Bloomberg clients.
Yeah, that's the big one. That's a tough one for you, right? Really looking into the crystal ball.
Yeah.
With a pretty vague sort
Guesstimates.
of... Guesstimates.
At best.
To live go is kind of where you're going to check out all of these discussions here throughout the next 2 hours. We're also going to be dipping in and out throughout, of course, of the day. But I look at the market action here right now. Of course, we're heading up to this Fed meeting, right?
Oh, yeah.
It's interesting.
I forgot about that.
We've gone through the BOJ. Surprisingly, the yen bulls are just gone now. And now I think it's up to the dollar to determine where the dollar yen's going to go.
That's... The BOJ height, you look at price action, it looks like they cut, right? So, Japan is close today, by the way. Nikkei futures are giving you exactly that vibe, right? We're up 1% on Nikkei futures, dollar yen 150.
The live audience is laughing when you mentioned that, too.
Well, Mr. Ueda, if you're listening, there you go. Message through. Maybe not. You're looking at Chinese, your yield curve right now. We're all the way from 2s all the way to 2.45. Yes, we're still below 2.3% on your 10-year CGB. Asia ex-Japan, U.S. futures looking like this. Taiwan is coming online. And by the way, when you look at some of these markets coming online, we have an LPR coming out of China next few minutes or so. Taiwan export orders are out end of the day. And also, I think we have rates out of Indonesia ahead, of course, at the big one, which is the Fed. Quick glance at, and we mentioned, of course, Japan is closed today. So we're looking at Treasury futures, and there we go. So we're up just about across the curve. So yields are pushing down continuously from the overnight session. And all that being said, we're still near year-to-date highs all across the curve. The dot plot, will that show 3? Will that show less than 3? What will they say as far as the balance sheet reduction is concerned. Stay tuned for all this conversation coming up. Glance, of course, at currency markets. There we go. We talked about dollar yen. I was mistaken. We're not 150. We're not 151.
Wow.
There you go.
All right, let's bring in our first speaker now.
Why not?
Chua, partner for special situations investment in Greater China and North Asia at Bain Capital. Ki, you've been sitting here for a while. Thank you so much for joining us and kicking off the credit forum here in Hong Kong. First of all, it's an interesting title that you have. Maybe you can introduce what special situations, what your coverage is.
Sure. Special situations, as Bain Capital defines it, really means flexibility. What we do is we create bespoke capital solutions that specifically target and address the needs of our counterparties. Meaning, we borrow in the capital structure, we borrow between terms and conditions that may be akin to debt, such as covenants, maturity profiles, governance structures, and then also try and structure for equity convexity. So if we're right, we get some upside. And what that means is that creates a really interesting risk-reward profile for Bain as well as the counterparty, because then they're actually getting specific capital targeted for the use that they need.
Right, and just to clarify as well, partly for our audience, this is mostly in private markets. Do you dabble as well in public markets?
We're pretty flexible.
Okay.
Bain Capital's special situations is Bain Capital's most flexible capital globally. So we can be in NPLs, we can be in private markets, we can be in public markets, and throughout Asia Pacific, we are investing as well.
And how busy have you been so far this year, Ki? I mean, given where we are in the credit cycle, and where are we in this credit cycle?
We've been quite busy. We think it's a really interesting time to invest in China, specifically, as well as in the rest of Asia. We don't have hard targets by countries, but because we're a pan-Asian platform, which means that we're allowed to ebb and flow between markets that we think are interesting. And we're still very focused on China. China is one of our core markets, as you mentioned. Right now, we think the economic situation in China is challenging, but it's understandable. When you have 20-plus years of above-average growth, you're going to have some hiccups now and then. And because we are long-term players, because we believe in the capability of the government to actually work through some of the issues in the marketplace, we think that it's very attractive and that there will be a return to normalcy and stabilization in China in the near term.
Right, and at the center of that, speaking of special situations, the property market is in a special situation at the moment. Where do you think we are in that story?
Property is a really large term in China, right? Okay. It represents approximately 25% of GDP, maybe more. And the way we define it is there's very different asset classes. If you think about traditional property, residential, commercial, we're in an oversupply situation. We're in a situation where developers, frankly, have been investing heavily into land banks, buying land, and trying to grow them without the requisite demand in place. And that property model, we think, is broken. And that ultimately led to what we saw in the high-yield markets, because they've been borrowing heavily, a lot of times from offshore markets, and then using that to buy land banks, because they were valued off of the number of years of land bank that they had, 8 years, 10 years, the more the better. And the flip side now, can they deliver on those properties? What we need to see is the execution of that. And that's why the government has been coming in to actually take projects off the land, sell off projects so that we can deliver those projects to the buyers locally.
And obviously we talked about this downturn entering to this new phase where you're talking about wind-up orders, you're talking about liquidation possibly on the table as well. In some ways, I mean, are you thinking that this restructuring is a year-long effort? Is it going to take months, years? How is this all going to play out?
Yeah, the sheer scale of the problem is actually pretty large, and there is no quick fix. There is no, I think the government's afraid of its moral hazard by just restructuring the developer. And so the approach has been, how do we take individual projects, how do we find the projects that are attractive and work through those? And when you do that, it's execution. It takes a year to 2 years to build out a project, right? And so by going in and taking each of these projects, it's going to be a multi-year process.
And you've been investing in China for so long now. I'm just wondering, in this current cycle in the property market, I think early on you said you noticed signs of maybe something was about to go south. What were those canary in the mines? Right?
Yeah, so our team, we've invested. Bain Capital has been in China for almost 20 years now, and so we have a large footprint on the ground. We have 3 offices in China, and our team is there every day with local networks. And what we saw was exactly the situation where developers were buying land, participating in auctions, reaching successive highs on a per square meter basis as they were buying things. And what we also saw was a lot of ghost towns. We saw a lot of property that was built where there was no demand. And if you look at the high-yield markets, was dominated by Chinese property developers that was borrowing cheaply from overseas. And so we largely stayed away from that. We thought this is a leverage situation, and if there's a hiccup in execution, if there's a hiccup in refinancing, the Chinese local banks have set limits in terms of how they were going to finance these properties, so it became an offshore and an onshore market, onshore and offshore market, and therefore we just thought this is not going to end well.
Okay, and what among those early warning signs you think either still exist in the market, or even if they do exist, where you have enough information to at least be actionable at this point in time?
I think the supply-demand situation is still a problem. It's not just in residential; it's also in office as well. Rents, we monitor rents in all the major cities. Rents have been declining as people have tried to fill the space. So you're seeing vacancy rates as well as rents still being soft, particularly compared to what we saw in 21 before the crisis happened.
I mean, the sticking point still remains that key hurdle, which is the physical market needs to turn around. When do you think that's going to bottom in some ways? And once it does, can credit markets bounce back?
Right, and does that solve the problem?
Yeah.
I don't know when it's going to bottom, but I do think that where we'll see it is as more and more of the projects get delivered and executed on. I mean, there's still a lot of buyers that haven't received their properties yet, people that have put deposits down, their life savings for several years. I think we need to see some movement in the restructurings of some of these developers, the 23 names. There's quite a few of them that have been in the process for over a year and a half. We need to see some satisfactory resolutions before foreign investors are willing to come back in and refinance high yield. We need to see some clarity and stability in the policies around property. I mean, the government's doing the right thing, but they're doing it in increments because, again, trying to avoid the moral hazard. I think that's going to be an important litmus test as to when the property market starts to come back.
That's a good point. I mean, timing this thing is incredibly difficult, if not impossible. And, what are, and not just yourself, players like yourself in the industry, what is sentiment like? What do you think people are watching very closely before they actually pull the trigger? And are we close to that point where you actually might see big transactions start to take place?
Yeah, luckily in the private space, and particularly with Bain Capital, where we have long-term capital, it's patient. We can wait. We don't have to be the first to run and take on the extra risk, right? In fact, I explained how we make our investments, right? We're actually very bespoke and tailored. I think the general market sentiment is that property has been a challenging sector. A lot of property funds and property corporates have actually pulled out of China, saying they're not going to invest further into it. We think that's short-sighted, right? We want to be in China long-term. We've invested in there. We have a lot of infrastructure and networks, and that allows us to keep our ear close to the ground. It may not be specifically the whole sector, but it could be interesting projects or interesting geographies, right? Real estate is about location, and that's how we are tackling the situation, trying to figure out specific sectors. And real estate, for example, outside of traditional real estate, we've actually been very active. We've been investing into the infrastructure that supports economic growth and domestic consumption, things like logistics, warehouses, manufacturing workshops, data centers. Those are growing at above average rates. Those are very stable. They're specialized, so you have locked-in tenants. And so there are different markets within real estate that we still find quite interesting. On the residential side, I think it's going to take some time because it's pretty commodity, and you need to have that long-term capital that's available before you can start to build these out.
Key, I think we're going to take a quick break
right
now because it is a live show after all. Chua there from Bain Capital. We'll have more from him, talking a bit more about his investment strategy coming up. And we are counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show live at Bloomberg's inaugural China Credit Forum. Good morning. All right, we're covering some breaking news here right now. You might have just saw it on your screens there with that loan prime rate that's been set by the banks here this morning, unchanged for both the 1-year and the 5-year loan prime rate here this morning. No surprises there, Dave. And overall, you're taking a look at what's going on with dollar China here right now.
No, and I think I was away the last time this came out about a month ago, right? And you had that fairly large cut on the 5-year, if I'm not mistaken. Yeah,
tied to mortgages,
There we go. So, unchanged here, 345. And by the way, you're looking at the currency on your screens. We're looking at 720, 21, 29. We're coming back a little bit on dollar China. Your midpoints of the day, 709.68. We're 12 minutes to the opening bell. Futures should be pushing high. We'll talk more about markets in a moment. Still with us here on set at the inaugural China Credit Forum is Chua, partner for special situations investment, Greater China, North Asia at Bain Capital. I think we ended the last segment on just really what the key sectors still remain in terms of, so residential, that's still fairly iffy at the moment. Industrial might be somewhere you're looking. How much have you guys invested in China, special sits, for the last few years?
Special sits, we've invested almost $2 billion over the past 7-8 years. And then as Bain Capital in China, it's been over $5.5 billion since we entered almost 20 years ago.
Right, and sort of within special situations, $2 billion. What's the current? Where are your current interests right now?
So special situations, we're actually industry agnostic.
Okay.
But what we do like to do is identify sectors and opportunities in the marketplace, and historically we've invested into non-performing loans, for example. But we've also invested into, as I said before, the infrastructure for domestic consumption. So logistics, warehousing space, manufacturing workshops. These are highly specialized assets that are needed to facilitate the flow of commerce in China.
And you're following the policy tailwinds in some ways,
we
too.
definitely are following the policy tailwinds, and so we are avoiding certain sectors that have policy headwinds.
Yeah.
But overall, we do like industrial. We do like consumption and consumer, and our team is constantly identifying interesting industries that have strong cash flows, that have stable cash flows and are growing, and also the ability for us to really structure. Because remember, we have the ability to be very bespoke, and so we can come in and structure payment in kind type securities. You can structure back-end dated equity convertibility. So companies that don't necessarily qualify for plain vanilla bank financing, we can come in and create something that really solves their problems and their needs. And particularly in the real estate space, that's actually required quite a bit of capital over the years. And in situations like this market where they don't have ready access to capital, it's a great opportunity for us to come in and create bespoke solutions for them and fill that gap in the marketplace.
Right. I talk a little bit more about that because that's quite topical, as I guess in many ways the official push, or the push from officials, is really to try and get the money where the money's needed, right? And there's quite a big gap between the official banking system where you are with shadow financing players like yourself. So yeah, what are you guys busy with and studying at the moment?
Yeah, so we're actually pretty comfortable that the government has the right policies and execution capability to remedy the situation. So you just discussed the LPR. They have quite a bit of policy room in terms of cutting the LPR, cutting the reserve requirement ratios to create more liquidity in the system. However, there's never enough liquidity in China because they're trying to grow, and there's a lot of export-oriented business, a lot of capital needed. And so our ability to come in and really provide that capital at a much-needed juncture in the market is actually really strong. We made 2 new investments in Q4 in China, pretty substantial check sizes, and we continue to see interesting opportunities.
Okay. Do you want to talk more about that, or the check sizes, or the transactions? Okay, okay. I'll skip. No, I was actually going to ask a follow-up on, and you talked about the LPR, right? They've taken rates down substantially in China, and I'm wondering, from your perspective, has that brought down the cost of capital for clients enough, in your view?
Well, generally, the people that we're dealing with are not doing standard secured loans, mortgages. And so it may be at 2-3%, but if you can get that capital, you're not going to be talking to someone like me, right? We're coming in and basically creating bespoke solutions for them. It's not necessarily going to be secured. Again, private credit is pretty broad. It could be senior secured direct lending, like mortgages and secured, or it could be mezzanine and sub-debt, or even convertible equity-linked type securities. Generally, we play in the latter half, where we are looking for more alternative investment type returns and the ability to actually create equity convexity when we're correct. And so those that can have access to standard senior secured lending aren't going to be, it's more of the investment grade side that...
So do you expect deal flows to pick up? I mean, especially in the distressed asset space, too?
Yeah, deal flow is definitely picking up. In these types of markets, there's a lot of dislocation. There's a lot of distressed assets. There's a lot of mispriced assets. Non-performing loans or specifically assets with debt against them that need to be restructured and need capital to come in are pretty interesting for us. And if you have the local presence, the local team, the capability and the track record and long-term capital, you can create some really interesting risk-reward situations for yourself.
Sounds like it's expensive to be your client. No. So I was having a look at the high yield, the Bloomberg high yield index coming in. So we peaked at 32%. I think we're now closer to about 14%, which might be just about some of the rates you're alluding to there. I guess my question is, when you look at the offshore bond market, because a lot of that also has to do with sort of how things have frozen up in some ways here. How long do you think before the offshore bond space heals? Is that a good way of put it? Or
I think investors are looking for a few things, right? First of all, some more transparency in terms of what's going on in the real estate sector. We need to see some more restructurings taking place, coming to fruition. We need to see some more concrete data about economics, what's happening in the environment. We need some clarity in terms of government policies. Right? There's actually quite a bit of positive policy support, monetary, fiscal policy, but that's trickling in, right, because of that moral hazard question. And finally, we need to see some recovery in the capital markets, right? The geopolitical situation isn't helping things because high-yield investors are generally from the Western world, right? They've been burned. They've been burned when their Evergrande bonds go from 100 to 2 cents, 1.5 cents. I think people need to see those resolve themselves. Then they'll have more capital to deploy back into the marketplace. So I think it's a multi-year issue, multi-year solution. The bonds that they invested into had weak, were structurally subordinated, had weak covenants, and I think we're going to have to see a reset of that if any new money comes back into the marketplace.
Key, we'll leave it there. We're running out of time now. Chua, partner for special situations investment in Greater China and North Asia at Bain Capital, kicking off the China Credit Forum for us. Coming up, we'll be looking at China's property debt crisis and what comes next for creditors in the real estate sector. We're counting down the market opens as well. But yes, talking a little bit more with the likes of UBS, Sullivan and Cromwell, and Admiralty Harbor Capital. We're going to take a market check?
Yep.
Update?
Yeah, why not? So as we await, of course, the next panel to get set up here at the China Credit Forum, inaugural, I should note as well. We are joined, let me bring in Annabelle, who's with us, of course, out of our studios right now. And Belle, sorry to keep you waiting. We've been busy. I know you've been busy. What's up?
It's been a great conversation, guys. I have loved listening to it. It's been really fascinating to watch this live coverage of our first credit forum. But, of course, there's a few different eco points to note. You mentioned we had those LPR decisions just down in the last few minutes. So we saw the 1 year being held steady at 3.45%. The 5 year also unchanged at 3.95%. Not really any big surprise to the market, given we saw the PBOC keeping its MLF unchanged last week. And as well, we had that stronger factory output investment growth to the start of the year. So perhaps there's a little bit less need for stimulus coming through. So that's the LPR there. Let's change on, take a look at some of the analyst actions that we're also tracking in the session today, and also the pre-market trading. It's actually looking a little bit more positive here. We did have a stronger session on Wall Street overnight, so that plays into it. Traders really looking ahead to that Fed rate decision coming out. But there's also a little bit more optimism, perhaps starting to stir in Chinese equities, and we're just marking some of those sectors that are entering bull market territory, the likes of materials, renewables, new growth stocks. Changing on to take a look at analyst actions in the session so far, there's really a couple that are standing out this morning, and that's Wuxi AppTech here. We had its earnings out, and we saw a significant drop in the stock yesterday in the session. Weak guidance for the course of 2024. A lot of uncertainties that are really facing this company here, and it comes down to the geopolitical situation, given that Wuxi AppTech generates about 70% of its revenue from the US, and we do know that the US is trying to restrict Chinese biotech companies that are operating there. So that is very much in focus. But broadly, if you take a look at what we're watching today in Greater China, again, it's that focus on geopolitics that's standing out today. We've got Wang Yi, he's China's foreign minister, on his first trip to Australia in 7 years. He's meeting with his counterpart, Penny Wong, today in Canberra. We've also had a great interview with Haslinda Amin with the Philippines President Ferdinand Marcos Jr. He's quite concerned, it seems, really the threat that his nation is posed from China's sweeping claims that we discussed in the South China Sea. That threat is going. New appointments at the PBOC. These are just some of the agenda items we're tracking in the session today. But again, that focus very much, as I said, on earnings, what we can expect for the numbers that are coming out so far. We have seen Chinese stocks sort of looking like they're starting to bottom out here, but what investors really want to know, they're sifting through the numbers. Is there any signal that we're getting really so far for a sustainable recovery? The early evidence of that, we have to note, it's not too convincing really so far, but some of the names that are standing out today, you've got Tencent, of course, Kuaishou, pretty big tech focus here, Sunny Optical as well, but taking a look at some of the ones we're watching in particular, Tencent, as I mentioned, let's just take a look at how it's trading as we await that market open. 1 minute to go so far, but Tencent here, pretty steady, again, ahead of these numbers. The expectation actually is that Tencent could fare a little bit better here. Big focus on what we see in terms of the margin, in terms of what we can expect around shareholder returns. Yes, the company's fourth quarter sales growth could be the slowest in a year, but still, as I said, some are anticipating its profit margins will beat the market consensus. So certainly a lot of things really to be tracking across the course of the session here today. As we said, this China Credit Forum, it's the first one we have ever seen for Bloomberg, and also, of course, on Bloomberg television. But this is the outlook here, just broader markets, again, as we await that open in mainland China and Hong Kong. It's pretty mixed in the session so far today. Japan, of course, is shut for a public holiday. Korea is really standing out there today, and financials are the one really to be noting. Of course, it's interesting on that day with the Fed. But let's take a look here, because we've just got the market open that's coming online here today. At the start of the session, look, pretty steady, pretty range bound so far. That's just to note. We've got the CSI 300 coming a little bit under pressure here today. The yuan there, fairly steady. Of course, it has been that monitoring around that dollar strength. We've seen traders really starting to refocus their expectations around whether the Fed, whether we get that signaling coming through that we're going to see perhaps 2 cuts over the course of 2024. 3 had earlier been priced in. We're coming down from 7 at the start of this year. So really a lot of changes are coming through there. But that's the outlook there. We can also take a look at other markets. Let's take a look at how Hong Kong's faring so far in the session. Got the Hang Seng coming online, HSCEI. Again, it's a bit of a picture of a slight weakness here. Interesting to note, because actually we did see China equities, or US equities rather, on Wall Street overnight, just pushing a little bit high. But we haven't really seen that translating so far in the session today. Perhaps, again, it does come down to that focus on earnings, what numbers we can get out of companies. And if you just change on, we can take a look at some of those that are in focus. But also, as I said, that watch today, our first ever China Credit Forum being held in Bloomberg today, Yvonne.
But we've been dipping back in. So, there's been opportunities, as we just talked about in the last panel, where the prices of the bonds in particular have started to jump. Within our portfolios overall, though, we've taken down the weights a lot. And a lot of that has to do with the volatility of the sector. So the volatility has actually been a lot higher than the equity market. So as a multi-asset investor, you naturally have to make some risk adjustment decisions. So not only has the sector been performing poorly fundamentally, we also have to take it down due to the volatility. And in fact, what we're looking at now is some of the equity plays. So we're moving into the equity markets now as opposed to allocating more to the bond markets. But we're still playing the market. So there's some bounces I was hearing, and it's been up since late last year. So we want to be participating in markets. Now, we're not in the workout situation. We don't want to get locked in. Nearly all of our funds are at call money, so we're a very different type of player than those distressed players. So we need to be in the liquid parts of markets.
Yeah, so although Hayden just mentioned that you don't want to get locked in, but of course we cannot discuss China property without mentioning distressed debt. So looking at that space now, we've really come a long way. We've gone through record defaults, massive amount of restructuring. To entering this year, I think Yvonne mentioned as well, we're really entering a new stage where you're seeing a lot more legal threats and legal actions following Evergrande's liquidation order. So Jacqueline, I'm curious for you as a legal advisor, and as someone who's worked on the case previously, what's your take on Evergrande's situation? How has the event impacted the work that you do as a restructuring advisor?
Yeah, thanks, Alice. Thanks for having me, first of all. Good to be here. I will put it this way. I would think Evergrande really is one of these cases. Of course, it's actually a beast of its own nature. But I would think Evergrande not probably necessarily drive all the actions and winding a petition we see at the moment, right? As Yvonne mentioned at the beginning, there are how many numbers of cases that we see creditors are eventually, how we call this, pull the trigger, right? I think it's really driving, what's behind this is really investors' frustration and investors' patience has been wearing pretty thin, as we have seen. I led actually from creditor side the Evergrande cases, many cases actually in this space. Right, you see actually Evergrande announced the default back in really 2021, September 2021, if my memory serves, and so has a lot of the other cases. That's been a painful, drawn-out process from the investor's perspective. As I said to many of the people who are actually present here, restructuring is really about faith. Yeah, it's about faith and also the shared prospect, right? How you observe the future and where you see future lies. I think it's really that is really driving Evergrande along with all the other cases that we have seen in the market.
We're talking about faith and shared prospects. How do you keep that going when the crisis is just dragging on for so long and maybe creditors are seeing very little outcome? I was talking about the increasing number of legal actions. I wonder for you, are you getting increasing number of inquiries or interests from your clients on trying to pursue more like the legal routes rather than peaceful commercial talks?
I think that really is the starting point of the advice has always been what the protection and the rights, right, you have under the instrument you are buying into. As Investor Hayden said, right, you and also mentioned by Chua at the beginning of the session, is talking about one key aspect of these China bonds, the U.S. dollar bonds issued by China Credit Properties Offshore, is a structural subordination, right? The so-called structural subordination, because a lot of them has no really asset security, has no meaningful assets actually held by these guarantors and obligors under the bonds, right? That's always the starting point of the analysis. And if you want to play stick, right? So what stick do you have, really? How big is your stick is really the question. So I think that's really driving the analysis, whether you should play hardball or whether you should be, as you, in your words, probably a bit more conciliatory in terms of your approach. But yes, it has been, a couple years in the process, and a lot of, like I said at the beginning, a lot of investors' patience are really wearing thin. But of course, that's cognizant of the fact that a lot of them actually buy into this with eyes open in terms of the protection and the credibility of the threat they would have in the process.
Yeah, so Jacqueline, you mentioned you have advised a lot of creditors, and sitting next to you, we have Patrick, who has...
Indeed, we work on the cases together, actually,
yes,
indeed.
Financial advisor for a lot of, on the company side of the situation. So not to get you two into a fight, but, apart from creditor frustration, what are some other major challenges in the restructuring business now, from your point of view, Patrick?
Yes, I guess the one of the challenges we're facing is, as Jackie correctly mentioning, is it's very hard for the both sides, from the property sector side and the company, from the investor side, to have a consensus. Right, so right now the sector is changing fundamentally, and it is very hard for us to perceive even the near future of the sector. And for a lot of our institutional clients, when they make projections, they tend to be defensive, or sometimes they, based on the current the resources available, they don't believe they would be able to service that in the foreseeable futures. And one of the challenges we're facing is the visibility of the sector is very low, and with that, it's very difficult to get both sides of the people to agree on the future. Without that, it's very difficult for you to have a deal agreed. That actually I would say, is the number one challenge we're facing.
Yeah, but with that challenge in mind, do you still see deal flow pick up from the property sector for you guys in the coming years? And if not, what are the other sectors that you're looking into for opportunities?
Oh, I definitely seen the speed of restructuring getting faster. In particular, in the current stage, we see a lot, liquidation partition, winding up partition in place. That actually give a strong push for the debtors to move fast. And that sometimes means they need to make a compromise to reality. And in terms of a new one, given the whole sector, the entire sector is under distressed, and they either have distressed or semi-distressed players there. I don't want to predict who will be the last standing one, and it's no point for us to predict that. But I do feel, so given most of people are actually already in current situations, I don't feel there's any more like a new wave of default coming through. There will be some certain names there, but it's what it is already.
Yeah, so what about the other sectors? As you mentioned, like maybe there's no new defaults coming from the sector, or very little. So are there other areas?
From the property sectors,
yes,
so we as
there you go. Welcome back. You're watching the China Show, and we're going to leave, of course, that there for Bloomberg subscribers. You can continue watching our inaugural China Credit Forum. That's live go for all of you. You can also find, by the way, all the big dairy entries coming up today, and not to mention, right, it's Fed week, so there's also that across these markets as we sort of try and digest what's taking place across these markets. Live go on your screens, as you can see. They're talking about where we are in the property story, offshore bond markets coming up, by the way, just to give you a sense of what's coming up. We're then going to LGFVs for the credit forum. We're going to private credit, and we're wrapping things up with what the future looks like for all things China credit. So stay tuned for lots of good conversations coming up. In the meantime, though, let's take it back to markets right now. One stock in particular, well, two in a moment. You'll see what the other one is. Prada, we're looking at this 4% drop at the open. Certainly information out of competitor Gucci and first quarter sales in the region are playing out as far as Prada's concerned. So we're down 4%, 250. We're down about 60 Hong Kong dollars a pop. Staying in luxury, let's flip the boards. Earnings out yesterday from Hong Kong, Shanghai hotels. First full year back in the green following the pandemic. We're up 1.6%. And by the way, if that statistic was slightly incorrect, the CEO is right beside me to correct me. The company just released, of course, operates Peninsula Hotels. The brand swung back into profits. Let's bring in Clement Kwok, exclusively with us, CEO of Hong Kong, Shanghai Hotels. Good morning and nice to see you.
Good morning, David.
Good year?
Excellent.
Really good year.
Good year.
Okay.
Very significant year because it was a year in which we finally completed the new Peninsula Hotels in London and Istanbul. Now, you're already aware that we are developers and owners as well as operators of our hotel assets. So in order to build these two hotels has taken a long time. We've invested a lot of capital, both financial and human, A lot of our people have been involved in building these hotels, and finally, to open them, in the case of Peninsula London, the construction budget was £1 billion. So you can see that was a very big commitment for us to make.
£1 billion to build the Peninsula London?
Well, that includes not only the hotel, but also some very high-end luxury residences as well. But the project has taken a long time. It's taken a lot of commitment from my people. And finally, we've opened these two very significant openings, which we hope will become amongst the best hotels in the world.
Right.
So that was the big thing for the year. Now, actually, if you look at our existing properties, the other hotels that are already in existence, we saw a very strong recovery in 2023. So the results of the other hotels were very good coming up, but we've had to also finance the openings of London and Istanbul. As you know, when you open a new hotel, you have pre-opening expenses, you have to build up your staff, you have to pay for them while they're being trained. And also, after the hotel opens, it takes a bit of time before your earnings can stabilize, because you have to build up your business base and so on. So those factors affected our numbers for the year. As you said, we still made a profit for the year, but that was from the combination of the existing properties making more money, but having to finance the cost of the new openings.
Right. So I guess in many ways, this financial statement, I'm holding it right now, and it really consolidates that. It would have been better, I think, and just to paraphrase, would have been better were it not, of course, for some of the sort of one-off expenses. Now, since we're talking about London and Istanbul, why don't we start with that then? How are those two properties doing? And generally speaking, how long before... Is break-even a good way to put that? How long before you typically see that turn?
Well, we usually use the word stabilization, and that takes 2 to 3 years, depending on the market and how quickly things build up.
Right.
In London, we're already seeing very strong demand and very good trends. I think, again, as you know, the location of the London hotel is superb. It is right on Hyde Park Corner, opposite Buckingham Palace. So it is in a very prominent location, and the hotel is really beautiful. So, the reaction and responses to that hotel have been very, very good. We've already hosted a major event in London called the Prince's Trust, which is King Charles's own charity. And so things like this have given a very high profile to this hotel. And so we're seeing the revenue trends starting to pick up. So that's very good.
Okay.
The Istanbul hotel, the location is wonderful because it sits on the Bosphorus overlooking the old town. So, when you stand on the grounds and you have gardens on the Bosphorus, it's actually a magical place. However, Istanbul, as you can imagine, our business has been a little bit affected because when we first opened a year ago, we had the earthquake in Turkey, and more recently with the uncertainty in the Middle East with the Israeli-Gaza conflict, that has affected the pickup a little bit. So, as I said, the pace of pickup will vary a little bit depending on market circumstances, but yeah, generally we hope that 2 or 3 years will be stable by then.
That's still a benchmark.
Yeah.
Okay. The pace of which, that brings me to Hong Kong. A couple of questions on Peninsula Hong Kong.
Yeah.
How far are we to pre-COVID levels? That's one part. And we were talking during the break, geopolitical tensions, right? That's such an abstract concept as it pertains to travel, I guess, in some minds, right? Can I draw a direct line between geopolitical tensions and visitors to a certain area? And are you affected by what's taking place?
Well, in fact, I mentioned earlier that all of our properties have recovered very well in the past year. And indeed they have, including Greater China, our peninsulas in Hong Kong, Beijing and Shanghai. However, those are the 3 hotels that have not recovered to pre-COVID levels. Now, I'm not a political expert. I cannot comment on geopolitics. All I can comment is what visitors feel when they come to Hong Kong. And I can say that I think we all know. People still ask questions overseas like, is Hong Kong a safe place to be? Now, a couple of weeks ago, we and some other hotel companies actually arranged for some of the very top travel agents from North America to come to Hong Kong to see for themselves. And really, I think that's the only thing you can do. You can show people that Hong Kong still has the vibrancy, the excitement, and everything that it had to offer before. And actually, these travel agents who were very senior, they were owners of the top travel agencies, they said, our eyes have been opened. We did not realize that Hong Kong is still such an attractive place. We all know Hong Kong is a very safe place to be, and people should be, have no concerns about traveling here. But I think we have to spread the word by word of mouth, by people coming to visit, and then are posting on social media, telling their friends and their contacts what they have seen. And I really think Hong Kong is on the way back. Now, from our point of view, we are seeing more long-haul international leisure travelers coming back. That is a segment that we've been missing more recently. We are seeing some trends coming, but I think all of us in Hong Kong should, help to promote and communicate that message to the international audience.
Well, I was going to ask you, what are future bookings looking like for the Hong Kong property?
We're seeing a gradual pickup. And as I said, we're seeing a bit more long-haul business coming back. But we need more. We need more.
How much growth do you see? Beijing and Shanghai, those two specific properties moving forward this year?
Well, I think in terms of long-haul travel, the same comment applies to Hong Kong, Beijing and Shanghai.
Right.
Beijing and Shanghai, however, as you would expect, we are seeing the development of a more affluent domestic market as well. And you would see that in the U.S., a lot of the customers come from within the U.S. And in China, you're seeing with the growth of affluence in China that more customers come from within China as well. So we're seeing growth in all of those places. Difficult to put a percentage on it, David, because, it's difficult to predict business a few months out nowadays.
When do you hope to reach pre-COVID levels if all things go to plan? Let's put it that. What are your assumptions?
Well, I think for the group as a whole, I'm really hoping to exceed pre-COVID by the end of the coming year. But, of course, we're always ambitious and we work very hard to try and achieve that.
I want to ask you about two things that affect not just you, affects the industry, affects the world. So we talk about inflation a lot on this show, and I'm wondering from your perspective, you have different properties across the world.
Yeah.
Are you still feeling price pressures? That's now part one of the question. The part two is labor shortages have been an issue for your industry.
Yes.
Has that solved itself? Where are we on that story?
The labor situation varies from market to market. It's tighter in some places and not as tight in others. But however, generally, you're right. There has been labor cost inflation. And actually, the price of luxury has had to go up as a result. In order to provide the services which customers expect in a top luxury hotel, the cost of providing that because of the labor cost has gone up, and therefore prices have gone up. If one looks at luxury hotel rooms around the world, definitely that pricing has gone up. However, there's still a lot of affordability of people, provided one supplies the right product, that there are people who can afford to pay for that product.
Is that the main source of inflation? Is it labor, or are there factors also coming in?
Energy costs and so on, but as a percentage, labor costs are by far the biggest component.
Right. Okay. Well, thank you so much for making time. It's great to see you. 22 years, 23 years?
22 years.
22 years in the job.
In the job.
There we go. Class is permanent, as they say. Clement Kwok, it's great to see you. Thank you so much, CEO at Hong Kong and Shanghai Hotels. There's plenty more ahead. We'll leave you with a live look at our inaugural China Credit Forum. A conversation, I believe, right now we're talking about LGFVs. We will be talking about LGFVs. So plenty more ahead, plus, of course, a full roundup of these markets ahead of the Federal Reserve. This is the China Show. Good morning.
To the next troubled area.
Thank you so much for having us.
Thank you.
Thank you.
And at the same time, I think that stance that coming from NPC in terms of the supportive nature, particularly on the monetary policy, they pretty much indicated there's a very high likelihood that there will be more rates cut coming through in 2024. And that's probably also helped the rally in terms of the rates.
Ivan, maybe you could talk a little more about the debt concerns, right? You're saying maybe they're a bit more bearable now, but is there still a real risk of some sort of credit event?
Yes.
Welcome back to the China Show. We're about 30 minutes into the cash market session. There we go, of course, in case you're wondering why I'm
for LGFV, they still have
sort of solo here. Well, the other one's right there, of course. There we go, the inaugural credit forum taking place. They're talking LGFVs there with Yvonne. We'll revisit a conversation in a couple of minutes. Just very briefly, though, other things happening. We'll talk about the world in a moment. Other things happening in China as well here. So you have this massive CGB rally, and we're at 2.28%. And while we're talking about credit, by the way, high-yield credit's been rallying virtually every single week, with the exception of one since mid-December. Yield there has gone from 32 to about, I think it's 15%. Stock Connect flow is still very much in focus here. We were up successive days into yesterday northbound. Southbound's been a different story, sort of more so as well. A visit, of course, from the foreign minister in Australia. We had this really great conversation, which will play out for you later on, with the Philippine president, Bongbong Marcos, on Philippine and China ties. PBOC appointment. On top of all of this, a whole flurry of earnings coming through in Chinese markets. Tencent is the big one to watch. Of course, Tencent is not the only one to watch, to be more specific there. Let's have a look at where we are market-wise. We're flat on the Hang Seng. 8 shares are doing slightly better. Not really a good narrative here, if you will. This is probably all down to just index construction, if you will. So let's flip the boards now. The rest of the region looking like this. Japan, by the way, is shut. So we're looking at futures. We're looking at Treasury futures. No Treasury futures today as well. No cash Treasuries, to be more specific. Taiwan's coming online. We have new export orders coming out of Taiwan. We have a rate decision in Indonesia today. There's the Treasury curve for you. Short end is up. Long end, 30 years, slightly down. And a glance at your currency markets. We were at 149 this time yesterday. Post BOJ, before the press briefing, we were at 150. And now they hiked. But the market says, did they cut? Question mark. Let's bring in our next guest, of course, Monica Hsiao, founder, CIO, credit asset manager, Triada Capital. It's good to see you. Should we start with the Fed or the BOJ? Let's start with the Fed.
Sure.
Why not?
So from our standpoint, we still expect them to leave the 3 dots unchanged. However, we acknowledge that it's quite iffy this time around. I think that with the data that we've seen come through, the U.S. economy is still quite resilient, and more so that you see the labor market is still relatively strong, even if it's cooling off. And as we all know, it only takes kind of 2 Fed members to move their dots for the median to move now. And so all eyes really are on that. I think I can tell that sort of positioning has lightened on both sides of the bets on that, because it is really uncertain. But also, of course, we're always going to be waiting for what Powell actually says. And this time around, I think there's going to be a bit more focus also on how the Fed is positioning the start of the discussion of tapering of QT. That will be another factor as well. So far, I think the market is right to start reducing the probability implied in the cut starting in June. I think there's still a good chance June is on the table, but if not, you can see sort of July, the market's still betting that July is pretty much virtually still a sure thing of the start of a cut.
Right. Well, that's what we said about March back in January.
Yes.
And then that got pushed back to May, went to June, went to July. Well, tell me, you talked about positioning now is fairly balanced in the Treasury market. If we do get those 2 dots shift and the median shifts to slightly less than 3, let's say 2, do you see more upward pressure in yields? How far can we go short term?
I think what will happen is that the market will likely, the first knee-jerk reaction will be that, okay, now we're going to have accelerated cuts the following year. So it'll be pushed out, and so I think at that point you're going to see a lot more steepening of the curve, particularly in the front end. Right. There is a vulnerable point, which is the 10-year. The 10-year, you're going to see more supply, and so 10-year, I think there's a psychological level of if it kind of gets past to 4.35, then you could see sort of a next level of 4.5. I do think though that we kind of the easier money is done in the sense that the last time I had always been saying that I think the market was wrong to kind of price in the cuts too early, and now it's pretty much consensus that it's going to be moved towards mid-year, and so I think at this point now. I would not be putting on a heavy positioning either going into the FOMC tonight. And I think it's fine to kind of let the chips fall a bit, and then we pick it up from there again. And, all of us, and I know the Fed is always saying, data dependent, but at this point you really are, because a lot of that positioning of the easy money of, okay, the market's overdone here, that's gone.
Yeah. So we've coalesced expectations and where the Fed is. You mentioned QT balance sheet reduction. Is there anything material we might get that could affect strategy and positioning there? What's a risk there?
Well, so the reality is, in my opinion, it doesn't hugely affect the underlying economy, in fact, when they start QT tabling, just because we have an abundance of reserves now anyway. But I think the market will always be looking for every point now, especially for this meeting, and knowing that it's really just going to be about the dots or QT, I think there could be some concern that that would be delayed. There is a possibility that they could delay that as well. A lot of people talk about what the Fed may or may not do in light of the elections and politics, and personally I still think the Fed is fairly independent, and so they're probably not going to be pressured to do something purely on the basis of elections.
Right. The possibility that they don't cut, that's come up, I think, a few weeks ago. How real is that? How cheap is that to trade at the moment? Is that getting more expensive?
So I guess what you mean is whether they don't cut this year, right? So I think that the probability is still very high that they will cut this year. I think that from looking at 2 to 4, I would be saying 2 to 3 now. But I think that the Fed, in my opinion, obviously they're going to watch to see the next few data points, but they have a bias, I think, still towards starting cuts. And I don't believe that they need a true landing. And by that, I mean also that my own probability has shifted on probably no landing this year. It's possible that no landing happens where the last mile just isn't achieved on inflation coming down to 2. And I believe the Fed would be okay with that and still start the cut. The point, I think, now is we do need to see some reduction of rent. And, anecdotally, in the U.S., I do think that there's been more redundancies. It's just, I think, whether there is a lag effect in it feeding through.
The other big part, too, when you look at pricing across the bond market, treasuries or even credit, for example, just a ton of supply coming to this market recently. Did you expect supply to come? What are your expectations around bond supply moving forward? So macro matters, but sometimes it doesn't really matter as much.
Yeah, I mean, global bond supply has definitely been front-loaded. And Asia, we've seen quite a bit of supply as well. However, we're still looking at, in terms of net supply, I mean, minus the redemptions and tenders and all of that, we're still looking at a negative net supply in Asia. So hence, this is the reason why the credit spread still goes tighter. And I think this is going to, another point for myself as a portfolio manager is that as the credit spread has tightened, this means that our whole portfolio as a credit manager, we're a lot more sensitive now to the rates. So hence, we've shifted from looking at corporate spreads to now rates. And that's why all eyes really are on tonight's FOMC.
Right. And I forgot to ask you about duration.
So duration-wise, we've been keeping relatively shorter duration, and all our sort of long end, we're hedged on DV01 flat. So we are trying to neutralize that, going into this. And in the past few meetings, I would have a lot stronger of a view of where rates were going, and this time around, I'm happy to stay neutral.
Okay. What do you say going into this Fed meeting?
Yes, going into this Fed meeting, and the next couple of data points.
Yeah, you have a few hours left on that, right? Very quickly, the Bank of Japan, is that worth talking about? They hike, market is doing the opposite. Why was the price action so dovish?
Yeah, if you look at the market reaction in the yen, you would be asking the question, is it worth talking about? But I think it's worth talking about in the sense that the market has decided to interpret it as one and done. And so the positioning starts to become, I think over the next few months, it's going to be so heavily that way that if they do any stealth tapering, it's going to be quite a surprise to the market the other way. But, I think that Ueda is probably right to leave all options on the table. He was wording everything in a very academic way, and I think that just wasn't pleasing to the market that had probably expected the rate hike to be a little bit higher, or they at least wanted some talk to guide them towards where are you going to start the sequential hiking. And to be fair, he doesn't need to give that guidance right now yet. So in the first place, he's already sort of moved up the timing from April to March. But yeah, for now, for the yen, all that matters is really the dollar, because this is really about differential of rates, and the yen will remain a funding currency. That's without doubt.
There we go. We started on the Fed. Somehow we ended back on the Fed. Monica, thank you so much. Monica Hsiao, founder, CIO, credit asset manager at Triada Capital. A glance at markets, 40 minutes into the cash market session. Here we've turned green now in the Hang Seng Index, HS Tech as well, 0.4%. We mentioned Tencent out with earnings. Want to watch, among other big names, due out with results in the next few hours or so. We'll leave markets there for now. We'll take you straight back to the ongoing China Credit Forum taking place here at Bloomberg's Asia headquarters. Live pictures of that. There we go. Plenty more in store. This is Bloomberg. Welcome back to the China Show. Let's turn our attention away from markets. Let's look at the South China Sea, of course, a flashpoint, increasingly so for tensions in the Asia-Pacific here. So you have countries, and here's a fantastic map here for you, including, well, you have China, the Philippines, Malaysia, and Vietnam all have, as you can see, overlapping claims in this massive waterway. Beijing, though, has claimed nearly all of it. Research-rich region here, including, of course, parts that Manila of the Philippines asserts that it actually belongs in an exclusive economic zone. So if you've missed the news recently, you've seen Chinese, well, just in case, Chinese and Philippine Coast Guard vessels have actually collided at least twice since October. The Philippine Coast Guard says a clash in early March actually left 4 people injured. That happened off this disputed second Thomas Shoal, which is acclaimed not just by 2 countries, by several nations as well. But it isn't just Manila and Beijing locking horns. Last year, if you recall, the U.S. military accused a Chinese fighter jet of coming in so close to an American bomber over that area that it nearly collided and caused a mid-air accident. The U.S. estimates that South China Sea holds trillions of dollars of offshore oil and gas. It's home to some of the world's richest fishing grounds and also a major trade route. Washington also estimates that a waterway carries some $3 trillion worth of goods annually, which actually works out to be, get this, 1/3 of global trade. All that in mind and all that at stake, let's bring in Haslinda Amin. She spoke exclusively, of course, the Philippine President, Bongbong Marcos. How was that conversation?
Well, it went really well. He was pretty frank in his comments. You talked about how there's been rising tensions in South China Sea, and according to Marcos, China has been pretty aggressive, forcing the hand of the Philippines, forcing the Philippines to respond in a bigger way. And that's not because Philippines wants to provoke China. It is about national security, national sovereignty. So he has to make the moves. The moves have been more visible. The Philippines has been more vocal, intentionally. It is about his people, he says. But you know what? He says in the end, he does not want war. He wants peace. He wants relations to go back to an even keel. His words. And he also said that he does not want to poke the bear. So you come away thinking he wants to bring down the temperature. Take a listen to what he had to say.
The threat has grown. And since the threat has grown, we must do more to defend our territory. And so maybe perhaps that's what we people are seeing is that a more robust defense of our territorial rights as recognized by the international community through international law, through the UNCLOS, And we hew very close to that. We do not leave very. We have not instigated any kind of conflict. We have not instigated any kind of confrontation.
The U.S. has weighed in. It constantly points to Article 5 of the Mutual Defense Agreement, which was signed in 1951. It now says that it now extends to all armed conflicts, armed attacks in any area of the South China Sea. In practice, what exactly does that mean?
That's an incursion, for example, to occupy, which has already happened, but we're still trying to keep it peaceful. But you see, we avoid, as I said, we think about peace in the national interest. It does not serve any purpose to heighten tensions, to say, okay, I am invoking now the Mutual Defense Treaty. And that I don't think anyone wants that, unless, you've asked a very difficult question here. Unless the effects are such that it is a threat, it will become an existential threat to the country, then I think it's very easy to say that would trigger the Mutual Defense Treaty, the agreement between the United States and the Philippines.
How confident are you about U.S. support? How far do you think the U.S. would go to support the Philippines in the South China Sea?
Well, thus far, we can say that the United States has been certainly very supportive in every way, and it has the United States has really shown that it takes very seriously these agreements that we have, and so, but it is dangerous for one to think in terms of when something goes wrong, we'll run to Big Brother. That's not the way we treat it at all. I say we do this for ourselves. We do this because we feel that we have to do it, and it's not at the behest or of the United States.
Mr. President, just to follow up on that, how confident are you the U.S. is willing to go to war with China over a disputed reef in the South China Sea?
Oh God!
How far is the U.S. prepared to go? What are your talks suggesting to you?
Well, I really, we would to take that a step back from that question is that is precisely what we want to avoid. We want to do everything we possibly can, together with our partners and allies, to avoid that situation whatsoever. This is not the poking the bear, as it were. We are trying to do quite the opposite. We're trying to keep things at a manageable level, to continue the dialogues, whatever they are, at every level. And we have initiated many of those dialogues. We have dialogues at the sub-ministerial level, at the ministerial level, and at the executive level. And so I think that's what we have to continue, because there are many volatilities in the area, in the region.
To put it in context, the clashes have been more frequent, prompting the question whether or not these clashes could eventually lead to a war. And, you know, it was interesting to point out as well that Marcos said both sides came really close to a tipping point. Yvonne.
Oh, yeah, but as you say, trying to avoid the existential sort of threats there, you know, has great conversation. I know you covered a wide range of topics, everything from geopolitics, the economy in the Philippines as well, as some challenges ahead. So certainly we'll have more from Haz's interview with the Philippine president a little bit later on. We'll take you back to those live pictures coming through here from the China Credit Forum. Yeah, Dave and I did a bit of a switcheroo, right? I'm back in the anchor seat. He's heading upstairs to prepare for his next panel. This one right now on private credit with our very own Laura Chen moderating.
We have a very large private equity business. Our private credit business is an offshore business, a U.S. dollar business.
Welcome back to the China Show. Let's get back to Bloomberg's China Credit Forum now here in Hong Kong, and our current panel looking at private credit in China.
So you basically assume your downside case is your base case. And, for us to enforce on collateral and structures onshore is more difficult. There are ways of doing it. There are certain, commercial arrangements that can be made, certain approvals that can be, created. But in the absence of that, we typically look for offshore collateral, offshore structuring, and basically domiciled in jurisdictions which are predictable and, the things that we can sort of control, as opposed to going through an unpredictable courts process.
Going back to Jenny, you are also looking at private credit across Asia or even globally. You have, U.S. borrowers coming to you for these, opportunities. Where do you see relative value in the China private credit market?
Well, I need China to be more a yield play. Right now, it's not there yet, not to the level that I wanted it. So actually, this year, we're focusing on Hong Kong. Hong Kong, we like it this year because I think all the cooling measures got lifted. Volume massively came back. I think last weekend, I see the new launch is 22 times oversubscribed. We like it very much. And in Hong Kong, we easily get to our hurdle rate of 15s because we do special situation lending, so our hurdle is a bit higher. We need kind of 15 hurdle. And in Hong Kong is actually easily achievable. We actually closed something 3 weeks ago that actually get to that kind of rate, right? So I think 2024, this is the focus. Hong Kong is the focus. Maybe 25 to 26, we can actually look at China again. I think China is not because of geopolitical reason. It's the macro situation that is a little bit tricky for us because we are the kind of firm that laser focus on principal protection and downside management. And right now, I think my willingness to buy the loan versus people's willingness to sell the loan, that gap is not closing. I don't see it close this year in China.
And Bo, from your perspective, are you seeing that valuation gap closing anytime soon?
Okay, so in terms of private credit relative value to developed markets, right, we're talking about versus U.S.
All right, we're going to leave it there when it comes to the private credit panel there. Our last one is going to be hosted by and moderated by our very own David Ingles. He's getting up to speed with that one here. That's going to be focusing on the future of China's credit landscape and what sectors are really looking the most attractive to investors in the longer term. All right, don't want to miss that one. We'll dip into that once we do get that underway. Take a look when it comes to markets here. Of course, it's still Fed day. We're watching some individual movers in particular. This is Qin's Therapeutics. So trading debut there in Hong Kong. They distribute medical drugs as well, immune disease antibody drugs as well. So seeing a big pop of close to 30% gains on its first day. And watching some of these Samsung chip-related stocks as well here this morning. They're doing this on NVIDIA. That effect's still going on in some ways. This is Bloomberg. Welcome back. You're watching the China Show. Of course, it's still Fed day today, so we're watching very closely what goes on with Treasury futures here this morning with Japan closed for that holiday post-BOJ. The Fed is up next to really determine where the Treasury market is going to go and where dollar is going to go as well. We've seen basically the short end really kind of come to the terms that maybe those Fed rate cuts are going to be pushed back, or at least fewer as well. We'll see if that plays out here. But 151 for dollar yen, that certainly is a shocker there after they, of course, hiked rates for the first time in 17 years from the BOJ, that we continue to see weakness in this currency. If we actually see less rate cuts in the dots from the Fed, is that going to roil that trade and that pair very closely here? That's certainly one to watch. You take a look at when it comes to Aussie dollar, we're still seeing a little bit of strength here this morning. Asia stocks are also catching a slight bid. So it is mostly risk on. Nikkei futures are also punching higher post-BOJ as well. You take a look at what Greater China and the like are looking like here right now. Obviously, there was that unchanged LPR, which was no surprise. Hang Seng is pretty much flat. CSI 300 just seeing a little bit of downside here, about a fifth of 1%. But it's pretty slow going when it comes to Shanghai here this morning. And we're really focusing on just on the Fed, but really earnings in China as well, particularly when it comes to the tech sector. Tencent is the next big one. Earnings reporting later on today may provide some positive catalyst for its shares, which have plummeted about 60% from their record high 3 years ago. For more, let's bring in our Bloomberg Intelligence senior analyst, Robert Lee. It seems like we're expecting some sort of, profit fall But you're saying you can look underneath the headline numbers.
Yeah, on the headline gap numbers, they're due to report there will be a decline. But 2022 numbers incorporate close to 200 billion or so of one-off investment gains. So when you strip that out on a like-for-like basis, the underlying business growth or earnings growth is in excess of 30%. So actually, the numbers they're going to report after the market closes today are pretty solid. And obviously benefiting from the base effect, benefiting from the reopening of the China economy, and also with some potential structural drivers that are emerging within the business, particularly on the short video front. So once you strip out those investment gains from the prior year, these are going to be solid numbers. So I think the market should take them quite well, with a risk that they potentially either come in line or, in fact, could exceed a little bit on the margin front.
Yeah, so margins certainly could be a good thing. Maybe any sorts of dividends or buybacks announcement there on that front. But overall, how's 2024 looking for Tencent?
Yeah, growth will normalise for them, as it will for all the Chinese companies. Again, the growth last year for 2023 benefited from this base effect and the reopening effect, so that's now played through. But Tencent's a business that can easily grow its earnings and cash flows in the double-digit range, 10 to 15% growth. If you look at consensus numbers, I think consensus is at 15 or 16% EPS growth for 2024. So that's a pretty solid number given the size and scale of the company. No, it doesn't match the sort of growth rates that are projected by Nvidia and the Magnificent Seven, but equally Tencent is not trading on those sorts of multiples. And as you said in your intro, the stock's down 60% from its high. I think a lot of people would agree that the risk-reward balance is quite attractive at this point.
Okay, that's why maybe you added Tencent into your BI focus list. Maybe tell us more.
Yes, when we initiated coverage on Tencent last February, we were more cautious on them because, again, I think there was a mismatch of expectations. The market was very bullish, thinking the economy's reopened, it's back to business as usual. We didn't believe that. The stock price was obviously substantially higher. I think there's been, we're looking at more realistic expectations from the market and the sell side going forward, and at the current valuations, again, there's an awful lot of bad news priced in. It's a relatively well-diverse, solid outlook for this year. This business is not an e-commerce play. It's not an Alibaba. The risk of it being undercut by low-cost competitors like Temu is just not there. So I think on a relative basis, Tencent looks good for this year.
All right, Robert. Thank you, Robert Lee there, a Bloomberg Intelligence senior analyst on what to expect out of those Tencent earnings. He says, look beyond just what the numbers you're going to see when they come out a little bit later on this afternoon. Let's get it back to those live pictures out of the China Credit Forum just upstairs with our last panel of the day on what's ahead, the future of China's credit markets. My China Show co-anchor David Ingles is moderating.
Participants that we have really learned a lot. One is don't assume the status quo. Okay, something that has been working for a very long time may not turn out to be working again in the future, right? So, for example, higher property credit, including Country Garden, we are seeing a 90% default rate, okay? So a lot of people used to say, okay, property is the bedrock of the Chinese economy. It's too big to fail. There's no way it can fail. Government will bail it out. Guess what? This is what we're looking at right now. So, and also to be able to distinguish early on in the stage between cyclical changes and structural changes is immensely important because, as everybody knows, cyclical changes, sometimes you can wait it out if you have the time, right? But structural one, usually you cannot. So that's number one. Number two is try your best to get the sector logic right, meaning you can examine the dynamic of the sectors and examine, what is the role of a certain sector play in the Chinese economy, because that would directly impact macro policy, and you have an understanding of the sensitivity and the limits, and they will go a long way to help you to, for your asset allocation and making your positions. And then finally, for particular in this round, what we have learned is we have spent so much time and so much effort in trying to understand the alternative financing source of a lot of the issuers, right? When the bond market shuts, alternative funding source become one of the few options left, right? So if you can spend your time, in fact, we has actually spent a lot of time for all the names within our universe to try to track down and identify whether any issuer can have alternative funding source. And, if you do your homework right, and you're right, it could be, instead of a drawdown, it could be a positive alpha generator.
Cecilia, same question but phrased a different way. What have you been busy with as people try and figure out where relative value is, and just trying to understand how do you calculate value given all the factors that Gordon just laid out?
Well, I guess because I cover the Macau gaming and the China internet sector, so I want to say is that in the past few years, not only the property market faced regulatory crackdown from the government, but also the Macau gaming and China internet sector face similar crackdown, but they are able to survive. And so one of the reasons is because they haven't overly leveraged. And then for the China internet sector, they have the strong net cash position, which gives them enough buffer against the operating volatility. And for the Macau gaming issuers, they have been actively managing or navigating their debt maturities. And so during the COVID times when there's actually zero revenue generated, but then they are still able to do okay, even though, of course, there are news about their concern on their leverage. But then we can see that now they are able to wait for example, China's reopening. We see that the gross gaming revenue being boosted up. So this is something that I think the market can learn, do not over-leverage.
Okay. Yeah, I think we that hit us in the face, didn't we? Well, Gordon, I'll bring you in on that, because those two sectors, high-quality bonds, tech in particular issuers, and Macau gaming issuers, those have come up time and time again on our shows as the favorites, the safe havens, if you will, amidst everything that's taken place. Do you feel the same way? Is there value elsewhere in this bond market, in your view?
I do feel the same way. For Macau, I like it for the stable profile. And everybody goes to Macau, right? And it's already reopened. But I think in the current market, some of the most interesting opportunity, in my view, is that, ironically speaking, right, what we have observed is that there's a general fear in the market upon a bond maturity, because people don't know whether people got paid, right, or not. But if you think it more positively, actually, the maturity of a bond could sometimes turn to be the biggest alpha generator for your portfolio. But here, your due diligence and your credit work become very, very essential.
Okay, well, alternative sources of funding, I'll bring you in that, John. How much of guys like yourself can come in and plug the gap? And I know the job is enormous, for example. How busy have you guys been?
Look, I think it's definitely the tech sector is very interesting, especially as some of these companies have been expanding into South and Southeast Asia. So I think that's a great opportunity. One of the sectors we didn't mention as a problem area was education. That's definitely been a similar story to perhaps the internet sector and the real estate sector. But the areas we particularly are focused on at the moment are areas like battery technologies, electric vehicles, renewables, wind and solar, all of which China either is a global leader in, or will be a global leader very shortly. So I think there are some fantastic opportunities as those Chinese manufacturing companies go offshore. And we're seeing a lot of investment in Indonesia, a lot of investment in Eastern Europe, particularly Hungary and Poland, and even in North America and in Canada, and also in Mexico. So all of those investments are very capex heavy and will need financing. So I think there's some very exciting opportunities in those areas.
How busy are you guys with new energy specifically? And now I'll talk to us, the world of creditors here.
It sort of comes and goes. Obviously, one of the things that we've done a lot of work on recently is a lot of the business is supported by the Chinese export credit agency, Sinosure. So they've been very positive in supporting investments offshore. into these international markets. And China still has a massive way to go in terms of sustainability and green financing. It's difficult to calculate exactly how much is green or sustainable out of the loan market, but it probably ranges between about 10 and 15%. And as China internationalizes, a lot of these manufacturing companies are adopting the international standards for green and sustainable finance. So I think that's a huge opportunity, because it's going to become the norm sooner or later, rather than just 10 or 15% of business.
Gordon, the role that people like you can play, credit investors can play in new energy?
I think historically, high growth company or new company, they usually don't tap the bond market for funding. They prefer to do equity financing or at best convertible bond market, because those are, from the issuer point of view, those are lower cost for them. But as you know, the equity market right now, the valuation isn't really rewarding. So I think, I'm hopeful that as a credit investor, we'll be able to participate in a new issue when issuer find it more attractive to raise funding through the bond or the loan markets.
I didn't get to ask you this. The offshore bond market just taking a massive step back. How would you describe offshore dollar bonds at the moment? Is the market functioning?
Well, it depends on how you define functioning. I mean,
well, okay. Can I trust the price? And is it a viable avenue to raise money?
When there's a buyer willing to buy at a price and a seller willing to sell at a price, then then that's functioning, right? But whether a certain price level really accurately reflect the fundamental, Evergrande at 2 cents or 4 cents, who knows to guess, right? But I guess the most important thing is to control your risk. And as I say, really try to understand the sector dynamics and the structural versus cyclical change. And from that, you can build in your own risk premium.
All right, we're going to leave it there when it comes to China Credit's future landscape. That panel just happening right now as we wrap up, of course, our China Credit Forum in just a few minutes' time. You can also turn to your Bloomberg for more if you wanted to watch the rest of it. T-Live Go is where you're going to go get commentary analysis from our expert editors. Plenty more ahead. This is Bloomberg. All right, we're seeing a little bit more risk on the table when it comes to the Hang Seng here today. We're up about 0.4%. So seeing a little bit more of appetite, I guess, when it comes to equities in this part of the world. We're still flat when it comes to Shanghai here this morning. But HS Tech is once again leading the charge. We're up about 1%. Obviously, 10-cent earnings are very much front and center in just the next few hours or so as well. 721. For dollar China this morning. We're more on the weaker side. Of course, it is still Fed day. All right, let's talk about Hong Kong now. The fast-track domestic security law is prompting new warnings from the U.S. and EU that it could muzzle open discussion in the global finance hub. For more, let's bring in Bloomberg's Asia politics and government correspondent Rebecca Chung-Wilkins. First and foremost, you've been looking into this new Article 23. Just give us through the details and some of this new, I guess, offenses that we're learning about.
Well, the key element here is really the overlap that we see between Article 23 and mainland Chinese national security legislation. There was, of course, going into this, some of concern expressed by experts and analysts over the vagueness of state secrets, the vagueness of foreign interference. Now, to some extent, there has been a little bit of clarity over that seen during the discussions that we've had in LegCo over the last few days. So, for example, these assurances that if you are conducting normal business and interacting with sort of foreigners or foreign firms and so on in a normal way, you will not be subject to any of the sort of worries and you will not be at risk. Still, I think because of the pace at which we have seen this legislation rush through the system, it is the fastest ever that we have seen since the handover. There are still some of these prevailing worries.
And we've heard from the Biden administration, some foreign leadership and dignitaries that have commented on it. What's the response so far?
Yeah, some quite sharp criticism from the US, the UK and the EU, main sort of folks that we've seen comment so far. The US talks about this sort of potential erosion of fundamental freedoms in Hong Kong, something that they have raised before. They also talk about the potential sort of to dampen the openness of Hong Kong. And the EU was perhaps quite specific, or the most specific. They raised this issue about extraterritorial nature of the law. They also raised that it seems it could partially at least be retroactive, and also that we might see these sort of harsher penalties when it comes to some of the issues over state security, for example. It is worth saying, though, too, that the sort of business and finance institutions, for example, the Hong Kong Chambers of Commerce, have come out in support of the law. They say ultimately this creates a safer business environment. And it's worth emphasizing, too, that, of course, Article 23 was mandated as part of the basic law. So perhaps for Chief Executive John Lee, having got this out of the way, the last major piece of national security legislation that he has to do, he can finally shift his attention and start focusing on some of the other issues, the economic being the big one, I think, on the table here.
All right, Rebecca, thank you. Rebecca Wilkins there, Asia politics and government correspondent, joining us on Article 23. We're also looking at live pictures from Bloomberg's China Credit Forum here in Hong Kong. Our current panel looking at what's ahead for China's credit markets. Yeah, that's certainly our discussion there with David Ingles moderating. This is Bloomberg.
Right now, we think the economic situation in China is challenging, but it's understandable. When you have 20-plus years of above-average growth, you're going to have some hiccups now and then. And because we are long-term players, because we believe in the capability of the government to actually work through some of the issues in the marketplace, we think that it's very attractive and that there will be a return to normalcy and stabilization in China in the near term.
All right, Bain Capital's Chua, they're speaking to us earlier at the China Credit Forum, and we are just wrapping up this event here in Hong Kong. Our current panel talking about the future of China's credit markets. That was, of course, moderated by our very own David Ingles, but it certainly has been a very exciting inaugural credit forum for us here at Bloomberg. Hopefully you enjoyed some of those conversations that we had in the course of these last 2 hours or so. We have more from our exclusive interview now with the Philippine President, Ferdinand Marcos Jr. He also spoke with Hsiao about the health of the economy and why he thinks GDP growth could hit 8% during his term.
Much of the policies that we've taken on are really to spur growth. That is part of that's the most important part, because it is only growth that will pull us out of the morass that was left after the pandemic. Even in terms of debt ratios, even in terms of unemployment, even in terms of inflation, it really is growth. That seems to be the key. Is it sustainable if we continue down this road? If we defend all of the things that we are doing, I believe it is. I believe it is. If we are also agile in terms of responding to the shocks that come up from the outside. To put it that way, shocks that we cannot control or can have very little influence over, if any. So that will be the key.
It's a 6-year term. Do you think you can get to 8% within 6 years that you're in office?
Sure. Why not? There's no. We always plan for the ideal. We don't plan for a mediocre result. We plan for a very good result. And as I said, we just have to adjust along the way as we continue to transform the economy. But yes, I think it is. I think it is doable.
Several banks are currently in focus because of interest rates. In the Philippines, rates are at, I think, 17-year highs. How much room is there for you to cut rates, or rather the BSP to cut rates?
We're still battling inflation. Inflation is still our biggest problem and when you separate core inflation to inflation that involves agri-products, for example, you can see that the core inflation, we're doing rather well in terms of controlling it. But again, these shocks that keep coming in.
But still not quite the time to cut rates because inflation is still sticky.
Perhaps we look at it almost every week to see if it's time to bring down the rates. We are not yet there.
And the peso at a 3-month high? Are you comfortable with the peso at a 3-month high?
Yes, because it's an indication of the strength of the economy. There is a downside to it for the Philippines because of our overseas workers, where the dollar is worth a little less than it normally would be. But I see it as an affirmation that the economy has grown stronger. And that's one of those obvious tests. And the dollar, I mean, of course, because it's a relative measure. The dollar has not depreciated. So if the value of the peso is increasing, then that is a good indication that again the economy has gained strength.
That's it for us from the China Show. Hsiao stepping in with Bloomberg Markets Asia next.